This is Bloomberg Intelligence.
We're really getting into now the streaming arms race.
This is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at what's at stake for banks as capital levels prepare for a boost thanks to a new Fed rule. Okay, but first, you got miners refusing to price in stubborn iron ore prices, a disconnect between the underlying spot and the actual commodity and the companies. For more, we're joined now by Bloomberg Intelligence senior metals and mining analyst Alon Olsha. Alon, walk us through sort of what the difference between the actual underlying spot price and the actual company. I know that they seem like they could be similar, but they actually can be quite different.
Yeah, absolutely. I mean, so what happens, of course, is, investors as a starting point, when they look at mining companies on valuations, they're looking to see whether the stock's trading, above or below its historical average multiple. That's usually the kind of benchmark that they're looking at. If it's above, it's potentially the market or investors are thinking that, earnings are too bearish. If it's below, they're thinking earnings estimates are maybe too bullish. And that's kind of really the jumping off point for this analysis. And kind of what we're seeing with a lot of the mining majors, so that's the big miners, BHP, Anglo-American, Glencore, Vale, Rio Tinto, to a greater or lesser degree, they seem to be trading at multiples which are below their mid-cycle levels. And it kind of suggests that investors are saying, consensus estimates might be a little bit on the optimistic side. And that's really a call on commodity price forecasts because that's really the differentiating factor here when it comes to consensus earnings estimates. And this is where the disconnect comes in because unlike other sectors or industries, in mining, investors can calculate how much money a mining company is making in real time, kind of every minute of every day, because we know that the products, the commodities they sell are publicly traded. So we know what the prices are every day. So we know that consensus is using price forecasts for certain commodities, which are actually well below spot prices. And if they use spot, there's actually potentially upside to earnings. And we're talking here mid-teens percentage upside to EBITDA for the likes of BHP, Rio, and Vale. So if the stocks are suggesting that consensus estimates are too bullish, but commodity markets are then implying that actually there's upside risk to those estimates, kind of by implication, investors are saying that maybe the strength we're seeing in certain commodities is actually not sustainable, and they're pricing in a pullback. And I think the critical point here, though, is just to be clear, this commodity price strength we're talking about, it's not broad-based. Quite the opposite, actually. I mentioned BHP and Rio Vale earlier, and the thing that's kind of tying all those stocks together, the common thread is that they all produce huge amounts of iron ore and metallurgical coal, which are all used in steelmaking.
So how do the companies, how historically have they been, how accurate have they been in terms of kind of forecasting where these commodities are going to be and, in fact, kind of hitting their numbers, for lack of a better term?
Generally, not that great. Forecasting commodity prices is pretty difficult. Not a lot of people get it right. And to be fair, that's not the game they're in. They aim to have low-cost, scalable assets so that they can keep producing no matter what the price. And certainly for the companies that I've mentioned, these are the major players in those markets, and they can produce at almost any price and still make very, very decent returns. But I think what's interesting now is the whole year almost, the market has refused, I think, to accept the strength that they've seen in iron ore and metallurgical coal prices, which are effectively a proxy for steel making in China. Consensus has consistently forecast iron ore prices, which are kind of well below where spots trended, and recently the same has been true for metallurgical coal. And what's happening now is kind of getting towards the end of the year. Those prices haven't come down. They keep sticking up there despite pretty bearish sentiment around Chinese growth. And it's forcing Consensus to capitulate. And after kind of 9 months, really since the end of January, of just deep earnings cuts, we're starting to see Consensus capitulate and earnings being revised upwards. So we're actually finally seeing, almost for the first time this year, some positive earnings revisions, 4 to 5% for this peer group, but the stock's just refusing to price in, so the multiples are compressing.
Out of all of the stocks then, what do you feel is the most undervalued in this kind of scenario?
Well, just on observations on valuation, I mean, it looks like, based on the analysis and the calculations we've done, that, Rio Tinto seems to be pricing in quite a significant pullback in iron ore prices, about 13% from spot at the moment. And it's trading at about an 8% discount to its long-run multiple. So there's quite a big buffer.
All right, well, we appreciate the breakdown for us, Alon Olsha. He is a senior metals and mining analyst for Bloomberg Intelligence. Thank you so very much.
Let's turn now to the copper market, where miners who were once buoyed by decarbonization-related demand will soon be facing new challenges. From Warwick, we're joined by Bloomberg Intelligence senior metals, mining, and commodities analyst Grant Sporre. All right, Grant, let's talk commodities here. What's the outlook?
Yeah, well, look, if we look at the commodity markets, and let's look at through the lens of copper specifically, I think base metals and copper's resilience could be tested over the next 2 to 3 years. We're starting to see the market move into a period of modest deficits. And there are two reasons for that. The first one is, look, China's property market, for copper specifically, is not the only demand driver, but I guess a prolonged weakness, could start to impact the broader market, or more sectors, like particularly through consumer confidence and vehicle sales. And we're not seeing the Chinese pull those old infrastructure levers with the same gusto as they have before. And then on the supply side, and this pertains to copper, but also the other base metals, is that, we've been through a number of years where the miners have really struggled to hit their targets because they've been still struggling with the hangover of the pandemic. They haven't done enough development work, but they just seem to be on the cusp of getting that right. And in copper specifically, the second half, just of the miners that we follow, could deliver sort of over 800,000 tons of additional supply versus the first half. So it's almost that perfect storm in the very near term, where we've got supply when you just don't need it, and demand sort of faltering.
So, Grant, when does it flip? Because you talk to anybody in the metal or even energy transition space, and everyone's like, yeah, we don't have enough copper, full stop. So then it gets so perplexing when you get these shorter-term supply-demand dynamics. When does it flip again? And all of a sudden it's like, oh, God, we don't have enough metal.
My best sort of take on it is with the sort of the momentum that we've built up, and bearing in mind a lot of the copper you're seeing that's going to hit the market over the next couple of years. These projects were initiated almost a decade ago, and that momentum starts to run out of steam by around 2026. So I think the real testing point comes in around 2026, 2027 is when, my best estimates or my best calculations, we see the market flip back into a deficit. And of course, it could be a little bit sooner. It all depends on how quickly China recovers from the current sort of malaise that it's going through.
Commodity analysts like yourself, you guys always tell me I have to have a good demand model. I have to have a good supply model. So on the demand side, how influenced is it by China?
Well, short answer, it's very influenced by China, because China is just over half of the demand of the world's copper.
There you go. Okay.
And I don't think that's going to change anytime soon. Yes, its growth rate might slow to 2 or 3%, but we're talking that off a very high base. But I think the thing with China is if it only grows 1%, then that's quite a lot of copper that's not being demanded. So it's getting China right in terms of the demand side of the equation is very, very difficult. And we come at it from a number of angles. We come at it from simply a GDP multiplier approach, or we try and do let's look at demand by each sector and try and unpick that. and we try and triangulate between those various methods.
So to that point, what's the right level, right? We get to the medium term where the sort of near-term dynamics for China sort of get put on the sidelines, and it's going to be more the longer-term outlook for the energy transition. What's the right price that incentivizes supply without oversaturating the market?
And again, we've seen a bit of inflation, so that is a little bit of a moving target. But I would have said most miners want to achieve around about a 15% IRR on their projects. They do move that around a little bit depending on where the countries are. So, a slightly more risky country demands a slightly higher IRR. You take 15%, and we back calculated, you're talking about somewhere around 7,500 to 7,700. That's a good incentive price for most projects to hit that IRR number. Even though copper's come under pressure a little bit, we're still above that price.
Grant Sporre, a senior metals, mining, and commodities analyst for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
The largest U.S. bank's capital requirements could increase by as much as 19% if regulators' so-called Basel III endgame proposal is implemented. For more on this, we're joined by Bloomberg Intelligence senior government analyst Nathan Dean. Nathan, explain Basel III endgame proposal to me like I'm a fifth grader.
Yeah, so this is one of the last remaining rules from the Basel Accords that the regulators are putting in place. And what this does is this is a recalibration of what is known as risk weighting of assets. And for the big banks, think JP Morgan, Bank of America, and Citigroup and so forth like that, it raises capital requirements by about 19%. Now, the good news is, if you call it that from the banking perspective, is that, we've seen comments from Jamie Dimon and Brian Moynihan that they can probably meet this requirement without having to maintain or tap into dividends or anything like that. Probably through retained earnings over the next 2 years. The bad news is that, and this is if you talk to Jamie Dimon and Brian Moynihan, is that, there are other things that are going to suffer as a result of this, mortgage lending, other types of, things that banks do in a rocky economy. And so this is actually one of the biggest and most controversial rulemakings that we have down here in Washington. And we've certainly seen a lot of pushback towards the Fed on this, but, they're still plowing ahead.
When you say endgame, am I the only one who thinks about the Avengers?
Nope, not at all. Everybody's made that joke before.
Okay, good, because Paul's like, what? Okay, fair enough. Thank you for not making me feel crazy, Nathan. So what is the pushback on that? Like, how did they go to the Fed and be like, hey, this is why you can't do this?
So, there's a couple of things that they're working here. The first angle is that they've gone out there and, we've seen these comments from the C-suite that if you're going to do this, you're going to harm, mortgage lending, you're going to harm other types of activities that banks do in an environment where, the economy is not the best at the moment. Now, the Fed is going to take that and say, thanks, but we've got studies that say, otherwise and so forth like that. But really what they're doing is they're trying to find sympathetic lawmakers in Congress because the Fed has a challenge here. They are trying to finalize this before the 2024 elections. Now, regulators hate finalizing things right before elections, but because they've waited so long to do this, you're looking at around August, September timeframe of next year. So any potential delay, and if you see any type of Democratic lawmaker on the moderate side, maybe like Senator Dick Durbin or Senator Chuck Schumer, if they make any comment whatsoever that they're not somewhat on board with this, it could potentially get pushed back. And if it gets pushed back beyond the election and President Biden doesn't win re-election, then this rulemaking could just be indefinitely delayed.
Nathan, the great financial crisis is more than a decade in the rear view. Why are we even talking about this stuff anymore? Haven't they regulated the heck out of the banks already? And haven't those regulations worked?
Well, this is actually one of the last remaining rules that came from the global financial crisis. So this was put in place years ago by the Basel Committee. This is the super banking committee over in Europe that the Fed is a member of. Now, the Basel Committee goes out there and says, right, we want you to do this. And the Fed says, great, we're going to do it, but we're going to do it 5 years from now. And so this is actually now where Europe's already implemented this. Okay. And so this is the United States playing catch-up to this. Now, The regulators waited a little bit later in the Biden administration to do this because they, for a variety of reasons, didn't get their leadership in place, and there were other priorities, and it took time. Look, this is going to be like a 2,000-page, this is like a 1,000-page proposal that's out there right now. So to get all these comments, to finalize and so forth like that, it just takes time, and it's going to be really interesting in 2024 if they can get this done. The comment deadline is in January, and they're going to have to move fast.
Does this solve any of the actual problems that are happening right now with banks?
So actually, this has little to do with the regional bank crisis that we had earlier this year. They were going to propose this no matter what. But there is some language in here that is more applicable to the regional banks. So regional banks are going to have to account for unrealized gains and losses. This was actually somewhat tied to the regional bank turmoil that we had earlier this year. So you're looking at a 4.6% increase in CET1 for these banks that are above $250 billion. Let's think PNC, Truist, and U.S. Bank. And for the banks that are $100 billion to $250 billion, you're looking at a 2.6 increase. So again, it's not really going to touch dividends. There are other proposals out there that deal with the regional bank issues a lot more, but the regulators were like, you know what, we have this thing out here called the Basel III endgame. Why don't we throw some regional bank stuff in there just for good measure?
So how about if if I'm not Jamie Dimon at JP Morgan Chase or Brian Moynihan at Bank of America, I'm somewhere kind of, I don't know, a 10th, 11th, 12th, 13th sized bank in size. How much of a problem is this going to be for me?
I don't think it's going to be all that much. It's a scary headline. Okay. I mean, the big brunt of it is obviously with those big mega banks. And if you're a smaller bank that's $100 billion and up, look, a 2.6 increase in CET1 is not great. It's not something you want to deal with, but it's certainly manageable. And so I think if you're one of these regional banks, you say, you know what, the regulators, let's let the regulators and the trade associations fight it out. We'll let the big banks fight it out. But it's not something to be that concerned about. So if you're a bank investor and you're really focused on the regional banks, this one's not all that big of a deal. There's another proposal out there called the long-term debt proposal. Again, not that big of a deal for the equity side of the equation. So regional banks are actually sitting somewhat pretty when it comes to a regulatory outlook.
What problem does this run the risk of creating? So I read this article in The Economist. This was years and years ago, but it's really stayed with me. And they outlined how every government response to a financial crisis has bred the seeds of the next financial crisis. And I'm just curious as to if there's something in this that will have sort of more disastrous repercussions later that we can see.
You actually sound like Brian Moynihan in his last interview with David Weston. He actually
I'm channeling him. Did I sound like him? I feel like my voice tone was very similar.
So what Brian Moynihan said, and there's a lot of support out there for this, is that, look, if you're going to put these restrictions on the banks, well, if I'm a bank, I'm going to stop lending. So where does that lending go? It goes to the non-banks. And, we've seen a lot of increase in private credit over the last year and so forth. And this is sort of counterintuitive to what Janet Yellen and the Treasury Secretary and the Financial Stability Oversight Council is trying to do at the moment. I mean, their concern is there's too much private credit going on.
Yes,
and if the hedge funds and the non-banks get into this, why aren't the banks getting into this? So it's almost like they're hitting the banks with this Basel III endgame. Lending goes to the private sector, to private credit, and then they're going to have to come over here and do something 2-3 years ago to address that.
That's exactly. I've been asking this question for a long time because I've been really noticing this extraordinary growth of private credit. And I've always said, boy, if I were a young person coming into Wall Street now, I'd think about private credit because that's where a lot of the money's going. But it's just one or two big credit blowups away from everybody saying, hey, what's this market over here?
Yeah.
What's Washington feel about private credit with the regulators?
Actually, they haven't done all that much. I mean, there's this initiative over at the FSOC, this Financial Stability Oversight Council. This is like a super, Justice League friend of regulators, if you will. What they have decided is that the non-bank financials, this private credit, this is becoming a concern. And so their thought is, okay, let's make these things systemically important, call them SIFIs. Now, this is something that they had done years ago with AIG and Prudential and so forth like that, and then that for a variety of reasons, that's no longer the case. So what Janet Yellen has done is they said, okay, we're going to rescind some guidance from the Trump era. We're going to put out new guidance that says that, we are taking a heightened interest in these firms. And if you're somebody like BlackRock, and I'm going to pick on BlackRock because they always are the ones that get thrown into this. If you're BlackRock, well, then the FSOC eventually, say 4 or 5 years from now, can say, right, we think some of your activities are getting a little bit too big of a systemic risk. Here's some capital requirements for your troubles. So I certainly don't think that's going to happen in the next 2 years. It would take a Biden second administration to do this. But if you're somebody like BlackRock or Vanguard or, just some of these hedge funds and so forth like that, it's something to keep an eye out on your 5-year plan.
Yeah, but it's like, how do you game what the government may or may not do in 5 years.
Yep.
That's probably a pretty difficult thing. Okay, Nathan, before I let you go, what else are you watching?
So, we have this, speaker race, which is happening at the moment. A lot of this stuff is
Oh, right, that little thing. Mm-hmm.
Yeah, exactly. So, a lot of it's going to dictate the government shutdown is on November 17th. So depending on how the speaker race plays out, the chance for a shutdown could be very high. What we are telling our clients, though, is just, scary headlines, but the ultimate market impact of a shutdown is not all that great. Even if you're exposed to defense contractors, these contractors usually have like 2-year contracts that they're working off. So any shutdown risk, lots of headline risk, little impact to markets.
All right, very good. As always, our thanks to Bloomberg Intelligence Senior Government Analyst Nathan Dean.
All right, coming up on the program, do Canadian banks have what they need to face commercial real estate risks head on?
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies and 130 industries worldwide.
Obviously, one of the biggest risks for banks is commercial real estate. Who has the exposure and what happens when that sector really rolls over? And we're already seeing the cracks. We want to focus that on Canadian banks, particularly office loans and the U.S. exposure that Canadian banks have. So for more, we're joined now by Bloomberg Intelligence Senior Banks Analyst Paul Goldberg. Paul, I got to be honest, when I think of commercial real estate, I do not go, oh my goodness, Canadian banks. What is the exposure there?
It's very similar to the U.S. banks, actually. These are money center banks, so the total commercial real estate exposure is about 10% on average for the largest banks, and the office of the total loans and the office exposure itself is about 1% of the total loans.
All right, so that's not that big a deal. So what's the deal here? What's the beef?
Well, it's not that big of a deal from a perspective of capital, so they're well capitalized and can take on some losses. It's more of a bigger deal if they have to build reserves, and that will impact their near-term earnings. The biggest issue why we sort of revisited that issue, because about a week ago or so, Canadian regulator OSFI put out their unusual mid-year risk review update, which they usually do once a year, which was largely focused on real estate, where they highlighted increased risks. And I have to quote this, but that came from their review. And they said, this indicates that the risk assessments, risk rating models, and collateral valuations may not be appropriately reflected in risk environment. So, to me, this is the message to the banks: raise reserves.
What banks? This is a really dumb question. What banks are we talking about?
So,
what are Canadian banks? Which ones?
So we're talking about 5+1 banks. We're talking about RBC,
okay,
TD, Scotiabank, BMO, CIBC, and a smaller, more kind of super regional bank, National Bank. The ones with the U.S. exposure that you mentioned up front, really all of them except for Scotiabank and National Bank. Everybody else has a very substantial exposure in the U.S. Anywhere from like 30 to 50% of the CRE exposure is actually in the U.S., not in Canada.
And how are the reserves, generally speaking, for these banks? Is there more of a need to raise capital of one bank versus another?
I don't think it's an issue to raise capital. It's an issue to allocate more in terms of reserves.
Okay.
So some of them are a little bit lighter. There is a fundamental difference between the Canadian commercial real estate loans and the U.S. Canadian loans actually have a recourse to the borrower, where U.S. not. So it's much easier to bring back the keys to the bank in the U.S. than in Canada. So that kind of explains some of it, but the U.S. is kind of becoming a more painful portion of the CRE exposure, actually, at this point of a cycle.
So aside from the CRE thing, which we can get back to, but that's really the credit risk part of the cycle. What we saw in the U.S. in the first quarter was the liquidity risk, the mismatch in liability and the liability risk. Did Canadian banks have the same issues on that front?
Not so much. They did a little bit, but Canadian banks are money center banks. Few of them are globally systemically important banks, so they are operating more like the U.S. money center banks like J.P. Morgan, B of A. So they actually run it through the capital levels, and they do run it through the write-offs, so it doesn't impact them in one chunk like it would the regional bank.
How have the Canadian banks performed versus kind of their U.S. peers?
Oh, yeah, because some of them have been hit so hard in the U.S.
They sort of held through the first half a little bit better than the U.S. peers. Obviously, they didn't have the 1H issues and some of the benefits that they actually got. The big TD Bank is a huge depository in the U.S., so they actually benefited them. But now they're all down double digits on the year, so they're kind of not as bad as U.S. regional banks, but they are turning over because people are concerned about credit quality, funding costs, and so on. Similar issues that we're facing here in the U.S.
In terms of the hit to net interest margins and deposit flight and deposit beta, so how much the deposit rate is going to have to rise to keep people's money in that bank, where are Canadian banks with those problems?
They're probably a little bit behind the U.S. banks, but I would say deposit betas are still well over 50%, so they transfer in most of it, and it's becoming more competitive as they try to keep deposits on the balance sheets.
What's the commercial real estate market like in Canada? Like, are people coming back to work in Canada? Because it doesn't seem like they're doing so much of that here.
Yeah, it sounds about the same. So a lot of people, like in the big areas, Toronto, Vancouver, so on, the average office vacancy rate is about 18% in Canada.
Wow. Okay. So
vacancy rate 18%?
Yep.
Hey, how about on?
So does that get like repurposed? Like what's going to wind up happening with that? Like at some point, New York is going to come back, right? It's like the city, but what happens in Canada?
It's probably very similar action to the U.S. And as far as you kind of look at the real estate, turning commercial to residential is a very, very difficult task because of the zoning, the rules, and all those things. So maybe it'll get repurposed to
for a mall. Remember the death of the mall, and now you're like, let's just put a mall in all the office buildings.
It's not that easy.
Hey, Paul, what's also different I learned about just recently over the last several years is about the residential mortgage market there. They don't get long-term loans there, do they? Are they more short-term?
That is correct. So it's more like actually the rest of the world market. U.S. is kind of unique. So they do get, instead of our 30-year fixed, they get their 25 fixed, but it's not really 25 because it reprices every 5 years.
Yeah, it doesn't.
Every 5 years. Okay,
yeah.
so is
so
there
going to? They have interest rate risk, whereas we don't.
A lot. So it has a lot of interest rate risk. A lot of those loans will be repricing in 25 and 26 because a lot of them were taken during the pandemic. So some of them are moving along in 23 and 24, but the bigger chunk of repricing will come in 25, 26.
So that might be then good for banks, but bad for people. So then how does that, but then to the side note, I've been waiting for that cycle to play out in the UK, and it just absolutely has not yet. We're still waiting for the stress, and it still hasn't happened.
It's a very similar story. So the markets, in terms of the way the loans are structured, is similar. And I think a lot of it has to do with the delay when the loans were taken and when the actual repricing comes in. They're also able to restructure those loans where you pay less principal and more interest up until your repricing in case of some of the variable loans and so on. So there's some help to the market as well.
Just real quickly, 30 seconds, Paul. What are the banks saying about the general health of the Canadian economy these days?
The story is roughly the same as the U.S., kind of soft landing. So that's really where they're looking for. But there are risks, obviously. You know what they say about the Canadian economy. U.S. sneezes Canada catches a cold. So kind of looks out of the border, and it'll be a good indicator.
All right, Paul, thanks a lot. We super appreciate it. Thank you so much, Paul Goldberg, a Bloomberg Intelligence Senior Banks Analyst. Well, beverages inherently contain a lot of water. And with extreme heat and drought all over the globe, the industry is going to face some challenges in the near future. So joining us now is Bloomberg Intelligence Senior ESG Analyst Gail Glazerman. Gail, first of all, just walk us through kind of the stuff that we drink, the stuff that goes into that, and then we can work our way back through climate.
Yeah, so the biggest one is going to be water. It may not be the most intense water user amongst industries, but that's literally what they're selling. So
this is like whether it's like Coke or like wine or, vodka, it doesn't matter.
It doesn't matter, except that when you move further down the spectrum, even the more water you use. So distillers use something like 25 liters per liter, where bottled water might use like 1.5.
Oh, wow.
So
Okay, so quite significant for
quite
your
significant
spirits.
depending on what you're producing.
All right, so frame out what the problem is or the challenge is for the industries.
Yeah, so the problem is climate change, heat, drought. Water is becoming increasingly scarce. A lot of these companies, their water use is going to come under increased scrutiny if just not be there. So obviously, if you're in a severe drought and there's no water, then you can't produce. But even if that's not the case, if you're using water and all the people around you, the local community, doesn't have water because you have access to it, that's a really bad look as well. And it can bring regulatory attention. So there are a lot of reasons why you might want to manage it. And to be honest, it gets even worse from there.
So what kind of companies, you have a great little table that I'm looking here in your work that says the water stress exposure percentage. What did you find in this exercise, and sort of how has it changed in the last 6 years?
I think the biggest change is it's driving investment decisions. So
Is it? That's interesting.
Absolutely. So a couple of years ago, I mean, some of this may have been political, but some of it was purely on water access. Constellation was building a brewery in Mexico, and it was largely built, and the government said, nope. They ended up having to take something like a $650 million charge, and they're now in the process of building a $1.3 billion brewery in Mexico that's further south where there's better access to water, but it's somewhere around 600 miles from the U.S. border, where the prior plant was maybe 10 miles. So
it just raises their whole cost of capital, and they're also eating the cash that they already sunk into a project.
Exactly. I mean, that's how extreme it can be if you're starting to build. So you really need to think about it. So interestingly enough, a couple of weeks ago, Heineken announced a new brewery in Mexico, and they're also building in the south. So there's going to be some operational costs, because assuming a lot of that's going to the U.S., but the government, literally the president of Mexico said a couple years ago, yeah, you're not building beverage plants in the north, you're building in the south where there's water.
Interesting. So what companies are doing maybe a better job than others? Do you have anybody who's out early in front of this, or who's doing a good job here?
I don't know if I have a strong view on that. I think each company needs to position themselves. So I don't know if I have a strong view on that.
But everybody's got a plan, right? Everybody's got a plan to cut my water usage, or, I mean, is that how they're trying to approach this?
They are. So they're all targeting water cuts as part of goals. They have a long way to go, generally speaking, to meet their goals. And those goals can be pretty specific. So if they're operating in an area where there's water stress, they are looking for greater water reductions. And then there's going to be extremes. You have companies, admittedly generally smaller ones, looking at recycled water.
Right.
So there's actually beer being sold.
I would think in the emerging markets, it'd be more of a challenge, right? I mean, because if you don't, they don't have a better water supply or better water treatment plants and things like that. But that's where the growth is, arguably, for a lot of these products.
It is. I mean, oddly enough, things like recycled water in certain emerging markets, they've been so desperate, they're actually more advanced on that.
Okay. Yep.
So I think there are some countries in Africa that are actually pretty good at doing that, and maybe a lot less stigma than there would be here of getting someone to drink it. But I mean, the risks are definitely catastrophic for not getting it right. Nestle exited water a couple of years ago, and the company that bought it is under attack from multiple states. California issued a cease and desist order for certain water basins. There's literally just a story I was reading on my way up here about Maine looking at and lobbying they were doing in Maine to push back on a threat to lose access. Michigan as well. So the cost of not getting it right is exceptionally high. Whether anyone's standing out on the high end, I don't have as strong a view.
So that's one way where the climate can really interfere with beverages. The other is the heat and the drought in terms of wine. So, I mean, we all live in the East Coast, so we were really affected by the Canadian wildfires and sort of the smog that we got. And that was like, 4 days? California, I mean, you live there, Paul. You guys deal with this all the time in California. So what's up with my grapes?
Yeah, it turns out grapes can absorb smoke from wildfires. And as you know, California is somewhat prone to wildfires. So a couple of years ago in 2020, the industry had just shy of something like $4 billion of damage from that. And basically, they were literally finding some of the grapes had absorbed the smoke and the wine was tasting ashy. So that's one way it can manifest. Another interesting way to manifest is champagne. Whoa. As in the region in France. Again, heat, drought. Turns out it's making the grapes taste sweeter. And so it's fundamentally changing the taste of the actual wine. And it's not only about wine, although that's perhaps the most sensitive, but still, if you open a can of Budweiser, you expect it to taste like Budweiser. Well, barley is also an agricultural commodity, and that's also at risk. There's some estimates that even under a favorable climate scenario, European harvest could decline 10%. Oh, wow. And again, the taste of the product is also going to be subject to the growing conditions. And so the barley you might use might taste differently. And so companies are plowing a fair amount of money into making sure that they have barley supplies, drought-resistant versions. One company has actually mapped the genome of barley to be able to help deliver this. And so there's worrying about the taste. And then, of course, there's also the cost. Mm-hmm. So if Coke has somewhere near $9 billion of sales that are tied to corn. Mm-hmm. And so if something significant happens to corn, there's a lot of sales that are that are at risk. So there's and that's for something like soda, which you don't obviously necessarily associate with agricultural commodities.
Right. But at least that way you can actually hedge with, on the futures market. You can't do that necessarily when it comes to water. All right, Gail, thanks a lot. Really appreciate it. Great analysis. Gail Glazerman, Bloomberg Intelligence Senior ESG Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.